Good afternoon, everybody. Welcome to the session on Does AI Matter for Monetary Policy? I hope you had a good lunch break. I am Wolfgang Lemke. I'm in the Monetary Policy Department of the ECB. I'm the head of the Capital Markets Division. In this session, we have two, I think, very interesting and quite different papers on aspects of AI that are relevant for monetary policy. So the first is focusing on financial stability, where AI actually plays a double role. So as identifying certain funds, and then in turn, they use AI, these funds. And this is presented by Wong from the Hong Kong Monetary Authority, and the discussant will be Pathan from Newcastle University. And the second paper is AI will be asked to pretend as a panelist of the SPF panel. So that's also super interesting. This is Sophia Kazinnik from the Stanford Institute for Human-Centered AI, and the discussant is Ehrmann from the ECB. So as usually, as you saw in this conference, we have 30 minutes for the presentation, 15 minutes for discussion, and then 10 minutes for general Q&A. So the floor is yours. Please, Joe, go ahead.
Testing. Hi, everyone. I'm Joe. I'm an economist at the Hong Kong Monetary Authority. Here, I would like to thank the ECB for inviting me to present our project on AI applications in the investment fund sector. This project is co-authored with my colleagues Victor Leung and Siru Liu. We have also benefited a lot from Eric Wong's comment. I hope that our finding will be both informative and valuable to today's discussion. Broadly speaking, AI refers to the simulations of human intelligence processed by machines. It covers a lot of technical areas like machine learning, deep learning, natural language processing, Gen AI, so on and so forth. Financial institutions like investment funds are increasingly using this advanced technique to improve operational efficiencies and facilitate more advanced data analytics. For example, fund managers can now apply AI techniques to their quantitative models to improve the accuracies of their financial forecasting and trading signals. They could also use AI to process a vast amount of information like news articles, social media posts, and written documents to track the real-time market sentiment, facilitating their momentum trading strategies. However, the use of AI in the financial sector could be a concern for financial stability, which may warrant further monitoring by financial regulators. This research was motivated by a report released last year by the Financial Stability Board. This report highlights several concerns about the growing use of AI in the financial sector. One particular concern is the potentials for widespread use of similar AI algorithms or models by investors. For example, in the context of investment funds, fund managers may apply AI to similar investment strategies. Their AI algorithm or models will be developed in similar ways and therefore generate similar trading signals or investment advices. This could increase the correlations in their trading activities. More importantly, the use of similar AI models or algorithms could pose a risk to financial stability. For example, in times of market stress, such as those resulting from the tightenings of monetary policies in major economies, these similar AI algorithms or models could advise fund managers to sell off assets simultaneously. If many fund managers act on these recommendations at the same time, it could amplify market procyclicalities and potentially deepen the market downturn. Against this backdrop, we would like to answer three research questions. Does the use of AI by investment funds increase the trading correlations among them? Second, if yes, does the increased trading correlations result from the common use of AI by investment funds, such as applying AI to similar investment strategies? The first one is, does the common use of AI by investment funds lead to collective asset sales among them in times of market stress? To answer these questions, we first needed to identify the AI usage of investment funds. However, there was no readily available data set indicating their usage at the time of our study, so we needed to identify by ourselves. We compiled samples of over 87,000 equity open-ended funds globally from Morningstar Direct. These samples represent about 70% of the total assets of the same fund type in 2023. We also collected their prospectuses from the Morningstar Documents Library. Each prospectus usually discloses the fund's investment strategy and often how they apply AI techniques to these strategies. So in the following steps, we will analyze these prospectuses to determine the AI usage of investment funds. In the first step, we establish a bank of keywords related to various AI subfields. You could see this, the English versions of this keyword in the left-hand side box. We have also prepared this keyword in a total of 28 languages, since all of these languages were in use across these funds prospectuses. The right-hand side figure illustrates our workflow. We use our own algorithm to detect whether these prospectuses contain these keywords. If a prospectus contains at least one keyword, we will suspect the corresponding funds as using AI and select it for further analysis in the next step. Conversely, the remaining funds will be presumed as not using AI. However, this keyword may not truly indicate the AI usage of investment funds. In fact, we refilmed samples of prospectuses and find that some keywords were mentioned only for describing issue irrelevant to the AI usage of the funds, including first, the background information, such as the market trends associated with the growing use of AI in recent years. Second, the profiles of fund managers, such as their AI-related working experience or education level. Third, the fund's investment focuses on stocks exposed to the AI-related sector. Therefore, we could not fully rely on the keyword screening. Instead, we needed to analyze each prospectus to make sure a more accurate identification. However, we also encountered two technical issues in this matter. First, there were over 16,000 fund prospectuses containing at least one keyword, which was an exceptionally large volume for manual review. Second, there were a total of 28 languages in use across this document, requiring us to have multilingual proficiency to comprehend and analyze this document. To overcome this challenge, we chose to use ChatGPT 4.0 latest to analyze these documents for us. In specific, we asked ChatGPT to read each prospectus and determine the AI usage of the fund. In the meantime, we require it to extract sentences from the prospectus to support its identification. For validations, we strictly follow academic literatures to manually refilm samples of ChatGPT output, and the result indicated that ChatGPT could almost perfectly identify the AI usage of investment funds. What is more, we went beyond academic literature. We imported all ChatGPT output to Code 3.5 Sonnet for further review. The schematic diagram on this slide shows our workflows of validation. As shown in the middle orange box, we imported each identifications and supporting sentences from ChatGPT to Code 3.5 Sonnet, and then we asked Code to analyze these supporting sentences and evaluate whether it could make the same conclusions as done by ChatGPT. As shown in the right-hand side box, if both models do not have any disagreement, then the AI usage of the fund will be fully determined by ChatGPT. Otherwise, if there is any discrepancies, we will intervene by manually refilming the prospectus and determining the AI usage of the fund. The whole validation result shows that the overall error rate of ChatGPT was just 1%, which was a very low level. For sure, we also manually corrected for this error before proceeding to the empirical analysis session. With the assistance of both Gen AI models, we successfully identify over 4,800 funds that use AI for making investment decisions, as represented by the red box on the left-hand side. Conversely, the remaining funds will be presumed as not using AI at all, as represented by the blue shaded areas on the same side. For empirical analysis, we needed to construct a matched sample of AI-driven funds and non-AI-driven funds with similar characteristics. To do so, we follow the literatures. For each AI-driven funds, we require the non-AI-driven funds to satisfy 3 requirements as shown on the right-hand side. First, each pair of funds must be established in the same year. Second, each pair of funds must share the same geographical and sectorial investment focuses. Finally, each pair of funds must have the closest level of total net asset compared to other alternative pairs. By using this approach, we successfully matched over 2,600 pairs of funds with replacement and proceeded to the empirical analysis session. Here, let me give you an overview of our panel data set. We have constructed a panel data set at the fund, time, and asset level. Our data is sourced from Morningstar Direct and Morningstar Documents Library, covering both AI-driven funds and non-AI-driven funds. Our sample period spanned from January 2022 to June 2024 on a monthly basis. We chose 2022 as the starting point since we believe that the use of AI in the financial sector has just begun to emerge more recently. Our data also covers over 35,000 assets held by the matched investment funds. They could be categorized into 3 groups. First, cash-like assets, including currencies, money market funds, and US Treasury. Second, risky assets, including equities, corporate bonds, and non-MMF mutual funds. Finally, derivatives, including future, forwards, and swaps. In this data set, we measure each fund's portfolio change with the log change in the numbers of shares of each asset held by that fund. We also collected data on each fund total net asset size, age, and monthly return. And each fund is classified as either AI-driven or non-AI-driven as per our earlier identification. Now let's just consider equation 1. We would like to use this to examine whether the use of AI could increase their trading correlations. In this analysis, I and J are the index of funds, K is the index of assets, and T is the index of month. In the equation 1, the dependence variable is the log change in the total numbers of shares of asset K held by fund I in month T. On the right-hand side, we have summation terms representing the log change in the total numbers of shares of asset K held by all funds J is not equal to I in month T. On the conditions that these funds J must be either AI-driven or non-AI-driven, as the same as fund I. This means that if fund I is AI-driven, then all funds J are also AI-driven, and vice versa. We also, and this summation terms is interactive with another dummy variable, AII, which is equal to 1 if fund I is AI-driven, or 0 otherwise. We also include some control variables and fixed effect in this equation. In this analysis, our coefficients of interest are beta 1 and beta 2. Beta 1 captures the trading correlations among non-AI-driven funds, while the sums of beta 1 and beta 2 capture the trading correlations among AI-driven funds. So under our first hypothesis, beta 2 should be positive if the use of AI by investment funds could increase their trading correlation. Here is our result. The leftmost columns are the results, contain the results based on the entire match samples, and the remaining columns contain the results based on the subsamples of different asset classes held by the matched investment funds. As you can see, both beta 1 and beta 2 are positive and statistically significant at the 1% level. This shows that AI-driven funds exhibit a higher trading correlations compared to non-AI-driven funds. Now we have already confirmed that the use of AI could increase the trading correlations among them, among the investment funds. However, the reasons behind these observations remain unclear. We would like to point out one possibility that these funds may be using AI in similar ways. For example, they may apply AI to similar investment strategies. To do so, we need to investigate these conjectures. We needed to identify various use cases of AI by investment funds. We once again used ChatGPT to analyze all of the funds' prospectuses and determine their different usage of AI. And it summarized 4 investment strategies where AI is predominantly used. The first one is asset value predictions, where funds may use machine learning technique to predict the performance of a specific asset, often used to identify undervalued assets for investment. The second one is market sentiment analysis, where funds may use natural language processing to track the real-time market sentiment, often used to facilitate their momentum trading strategies. The third one is thematic screening, where funds use natural language processing to analyze relevance documents and identify assets under a specific investment themes. And these investment themes are usually diverse across funds. Finally, ESG risk analysis, where funds may use the same technique to analyze reference documents and evaluate the ESG risks associated with a specific asset. And these ESG risk factors are also diverse across funds. Now we consider equation 2 to estimate the trading correlation between different groups of AI-driven funds to address the second question. In this analysis, we exclusively focus on the samples of AI-driven funds. The dependent variables remain the same. On the right-hand side, we introduce 3 dummy variables to represent different use cases of AI by investment funds. The first one is AVPI in green, which is equal to 1 if fund I uses AI for asset value prediction. Second one is MSAI in red, which is equal to 1 if fund I uses AI for market sentiment analysis. And the final one is OTHI in brown, which is equal to 1 if fund I uses AI for other investment strategies. On the same side, we also introduce several summation terms. To illustrate, let's consider the pairs in the first line. The left-hand side one captures the lot change in the total numbers of shares of asset K held by all funds J is not equal to I in month T, on the conditions that these funds J's are using AI for asset value prediction, as represented by the notation AVP J is equal to 1. On the right-hand side, you could see the summation terms. These summation terms represent the lot change in the total numbers of asset K held by all funds J is not equal to I in month T, on the conditions that these funds J's are not using AI for asset value prediction. And these summation terms are interactive with the dummy variable AVPI, and the remaining summation terms are defined similarly, as each corresponding to different investment strategy as per their notation. To further clarify how we should interpret the coefficients in equation 2, we have prepared a matrix on this slide. This matrix highlights the trading correlations between 2 different groups of AI-driven funds. The rows represent fund I, while the columns represent funds J is not equal to I. When both groups of funds are using AI for asset value predictions, then the corresponding coefficients is pi1 in green, which capture the trading correlations among funds using AI for asset value prediction. Similarly, pi3 in red captures the trading correlations among funds that use AI for market sentiment analysis, while pi5 in brown captures the trading correlations among funds that use AI for other strategies. Conversely, if both groups of funds are using AI for completely different investment strategies, then the corresponding coefficients would be pi2, pi4, and pi6 in gray. So under our second hypothesis, pi1 will be greater than pi2, pi3 will be greater than pi4, and pi5 will be greater than pi6. if the trading correlations are stronger among funds that use AI for the same investment strategies. Conversely, pi 2, pi 4, and pi 6 in grade could be either 0 or negative if funds using AI for different strategies invest in a rather mixed or uncorrelated manner. Here is our results, and they, to a large extent, support consistent with our second hypothesis. As you can see, we find pi 1 and pi 3 are positive and statistically significant. It shows strongly positive trading correlations among funds using AI for asset value predictions or funds using AI for market sentiment analysis. Conversely, pi 2, pi 4, and pi 6 in grade are either 0 or negative, showing that the trading correlations among funds that using AI for different strategies are rather weak. Finally, we still see some results are not strongly consistent with our second hypothesis. As you can see, pi 5 is statistically insignificant. It shows that funds using AI for other strategies may invest in a rather mixed or uncorrelated manner. One possibility is that, as I've mentioned earlier, these funds focus on a diversity of investment themes or ESG risk factors, so their investment behavior may not be quite correlated. Next, we will examine how AI-driven funds respond to market stress. To answer the third question, and we hypothesize that their responses may be highly varied with different investment strategies. In specifics, funds using AI for asset value predictions may tend to invest in a counter-cyclical manner, since their AI-powered predictions may help them to be better positioned to identify undervalued assets and buy the dip in times of market stress. Conversely, funds using AI for market sentiment analysis may tend to invest in a pro-cyclical manner, since their sentiment analysis may help them facilitate their momentum trading strategies, where funds may buy assets during market booms while sell assets during market bust. For the remaining funds, we hypothesize that their investment behavior, their responses to market stress may be quite mixed, and there is no clear signs of their responses to market stress. Since, as I've mentioned earlier, they focus on diverse investment themes or ESG risk factor, so their investment behavior will be rather mixed within them. Here we consider equation 3 to estimate the portfolio adjustment of different fund types in response to market stress. Here the dependent variable remains the same as the log change in the numbers of shares of asset K held by fund I in month T. On the right-hand side, we introduce 3 types of dummy variables. The first one is stress T, which is equal to 1 if the VIX index for month T exceeds the upper quartile of the sample period. And the stress period in our sample predominantly captured the hawkish period by the US FOMC in early 2022, as well as the subsequent interest rate hike of 50 or 75 basis points. Second, we also introduced several dummy variables to represent the diverse usage of AI by investment funds. They include 1 minus AII, AVPI, MSAI, and OTHI. Finally, we introduced 2 more dummy variables to represent the different asset classes held by investment funds. The first one is cash K, if asset K is a cash-like asset. The second one is risky K, if asset K is a risky asset. In this regression analysis, you could see beta 1 captured the percentage change in the numbers of cash-like assets held by long AI-driven funds I in response to market stress. Conversely, beta 2 captured the percentage change in the numbers of shares of risky assets held by long AI-driven funds I in response to the same financial condition. Similarly, other coefficients capture the corresponding change for different fund types. First, pi 1 and pi 2 capture the change for funds using AI for asset value prediction. Second, pi 3 and pi 4 capture the corresponding change for funds using AI for market sentiment analysis. Finally, pi 5 and pi 6 capture the corresponding change for funds using AI for other strategies. Here we specifically distinguish cash-like assets from risky assets, since we believe that funds may adjust their holdings of different asset classes differently in response to market stress. If a fund's investment behavior is counter-cyclical, it would tend to reallocate from cash-like asset to risky asset to buy the dip in times of market stress. Conversely, if a fund's investment behavior is pro-cyclical, it would tend to reallocate from risky asset to cash-like asset to avoid market risk in times of market stress. Here we did not specifically discuss the adjustment in derivatives, since we believe that the adjustment would be rather mixed or ambiguous, since the purpose of using these instruments are unknown. They could be used for either speculations or hedging. So under our first hypothesis, pi 1 would be negative and pi 2 would be positive if funds using AI for asset value prediction invest in a counter-cyclical manner. Conversely, pi 3 would be positive and pi 4 would be negative if funds using AI for market sentiment analysis invest in a pro-cyclical manner. Finally, we believe that pi 5 and pi 6 would be insignificant if funds using AI for other strategies invest in a rather mixed manner. So here is our result. As you can see, pi 1 is estimated to be negative, while pi 2 is estimated to be positive. This shows that funds using AI for asset value predictions invest in a counter-cyclical manner. Second, you will find pi 3 is estimated to be positive, while pi 4 is negative, showing that funds using AI for market sentiment analysis invest in a pro-cyclical manner. Furthermore, you find that the pro-cyclicalities of this fund type is even stronger than that of long AI-driven funds. As you can see, pi 4 is more negative than beta 2 at the 1% level of significance. Finally, we find pi 5 and pi 6 are both statistically insignificant. This shows that funds using AI for other strategies invest in a quite mixed manner, and their responses to market stress are also rather mixed. To conclude, actually our result empirical shows that the use of AI by investment funds could increase the trading correlations among them, but on the conditions that they apply AI to similar investment strategies. However, their similar applications of AI do not necessarily lead to collective sales among them in times of market stress, since we find that their responses to market stress could be highly varied with their investment strategies. It depends on how they use AI techniques. So our findings carry two important policy implications from the perspectives of financial stability. First, any risk associated with the use of AI should be evaluated with using a Leung's approach that well acknowledge the heterogeneities of diverse AI applications, such as applying AI to different investment strategies. Secondly, among these use cases, the pro-cyclical ones identified in our study should warrant further monitoring by the financial regulator in the future due to the potential dangers it could pose to the financial system. Here, I would like to remind the audience that our results should be interpreted with caution due to some limitation. First, we identify the AI usage for each fund based on funds prospectuses only. Okay. While it is common for academic literatures to rely on these document types to collect data on the fund characteristics, there is no guarantee that this document type, these disclosures are completely accurate. Second, funds investment decisions-making process might still involve a certain degree of human judgment. Actually, we may not be fully informed of to what extent they relied on their underlying AI models in the investment processes. So our estimations just reflect the impact of the partial usage of AI by investment funds, rather than the full usage of AI by these funds. This is the end of my presentation. I hope you enjoy. Yeah, thank you.
Thanks a lot, Joe. And Shams, to please discuss the paper.
First of all, thank you very much to the organizer for the opportunity to discuss this paper. My name is Shams Pathan. I'm from Newcastle University in the UK. So just a brief outline of my understanding of this topic, although Joe has done a fantastic work in explaining the topic to us. So this paper is about addressing how the AI adoptions by particular asset management has an implications for financial stability. So the idea is quite interesting and quite innovative in terms of looking the effect of how the AI being adapted by particular open-end funds, and they're different based on their different investment strategy. How does that impacts their trading correlations? And the other aspects that is quite interesting is that the way they have collected the data they have used generative AI to review they started with 80,000 prospectus, which is quite large, which captures about 70% of the population from Morningstar. Then eventually with different filter criteria that reduces to about 2,000 treated and about 2,000 controlled sample. So, and then the other aspect that is I quite like about this paper is the way they have captured at times of financial stress. How does these mutual funds have an implications for financial stability in terms of their asset sales? And their results are quite useful particularly for the policymaker, where the policymakers are constantly trying to understand the impact of AI adoptions at the financial institutions and how does that impact the their operations means for financial stability. So I have got a paper which addresses the financial stability for financial institutions directly for commercial banks, and our results are quite approaches and the findings are quite different from these aspects. In that sense, I thought that this paper provides a new and innovative approach to look into the issues for us. And what particular aspects that I liked, as I've already mentioned, that this is a timely topic from both from academics and both from the industry and the regulators' perspective, to have an improved understanding of the AI adoptions and their means for financial stability using the Nobel data set, and of course the thoughtfully categorizing the assets, investment strategy and asset sides to shed light on the effect of the financial, at times of the financial distress. How does that impact their decision-making process? So having said that one, so I have got 6 or 7 different comments on this paper. As this paper is still building, I was talking to Joe, so he was mentioning that he's still building the topic with his co-authors. So the comments maybe he already aware of, but I just wanted to highlight those comments just to see that if that makes sense or not. So I will try to highlight the top 3 comments, then the other, if time permits me, then I will cover those other comments as well. So first of all is the measurement of the procyclicality. So the way that Joe's measure has procyclicality is based on net assets flow. So which is good, but there are a few other ways that we can do that. That is the price impact measures. That is how much price moves after AI-driven funds reduces its holdings. And also the other one is amplification factors. So which is, do AI funds sell at a faster rate compared to the non-AI driven asset manager? So that covering that aspects will strengthen their conclusions. The conclusions they wanted to draw that AI-driven funds is basically poses a strong trading correlations compared to the non-AI-driven funds, and that will then provide a core message to the policymakers. So in this case, my suggestion will be consider adding additional robustness checks with these complementary measures if it found that is feasible. Okay. The second one is about the matching process. So in your paper, you have mentioned 3 to 5 different measures, the way that literature has covered to match the treated and non-treated farms. So one was the Jean et al., which has been published at Review of Financial Studies, and the other one is Jeffers. So out of these 4 or 5, this stands quite strong because they're already been attested by publications in top-tier finance journals. So out of these two, you have approached the Jeffers one, which is great, but I thought that Jean et al., their approach is quite innovative and quite vast. So if your matching can be alternatively tested with that approach, that will be again quite substantially. You can provide confidence on your results. So consider at least Jean et al. Matching's approach, which appears to be more rigor, at least to me. Okay. So and then you have mentioned about the Jeffers on the ground that these measures are rigor, and then these measures is data availability. So your choice for Jeffers needs to be also be justified. It needs to be elaborated why you have approached Jeffers. Just not only saying that they are rigor and they are because of the data availability. You need to justify a bit of more. I will be happy to get a more confidence on that why you have chosen that particular approach of matching, which is quite important for this study. And that comment then leads us to my third comment, that is on the causal inferences challenges. So your paper employs a matching strategy, of course, that is great, which appears to address the observational differences between AI-driven open-end funds and non-AI-driven open-end funds. But how about the unobservable factors, such as like the managerial skill, risk appetite, or fund clientele? Could still drive the differences between AI and non-AI driven adoptions, and then also the procyclical behavior which you have presented in your paper. So I will suggest you that consider discussing this omitted variable bias more explicitly, if feasible. Test for placebo effects, that is not only during the stressful time period, but also non-stressful time period. How does that impact difference between different type of asset classes, the way that you have tried to show that asset sales are not uniquely observed at times of crisis period. And then the fourth one is about the transparency on your generative AI classification process. So you have taken some time to explain your different filtering process from 80,000 prospectus to 16,000, then also to the 2,000, and then also cross-checking, validating with the Claudia one. And then where you have seen some discrepancies, then you have manually checked all those things. But it will be good to provide a bit more information about that process, merely saying about that the filters being used that way. So it will be good to see that what exact prompts that you're using, and then where the ambiguous cases are dealt with, and also the what was the intermodal generational comparison rate. Okay, so consider including a short-term methodological appendix with examples of actual prompts, sample fund disclosures, and how decisions were made in borderline cases. That will be great to get a complete pictures and better understanding of your way to build your sample. And then the external validity. As I mentioned, that your paper considers the open-end funds, and which is 80,000 considers 70%, right? But the actual sample includes around 4,000, and which is only teeny bit of the market segments. So in this case, how does that can be generalized for the other financial institutions? So I know that this is something that not part of your project, but that can be said that if somehow that can be captured, that for hedge funds or quant funds or ETFs, how that can be applicable. Possibly if it is not, then expand the discussions of external validity in the conclusions and outline opportunities for extending the analysis for other asset classes as well. So the other aspects is, this is not that much of an important compared to the other comments that I provided. This is more of the, to find out that if more is better, right? So your literature review is the way that you have explained it, 4 different types of literature review, but it doesn't get into the insights on the literature. So for example, from this morning sessions from Professor Jonathan, we get to know different way of looking into that AI adoptions in the economic implications, right? From the productivity perspective. So from finance background, so we don't get to see use those lenses. So see that if that lens is useful to enrich your literature review sections, and also the way that you have presented the 3 different research questions. So it seems to me quite ad hoc. So it needs to be expanded to provide a bit of more information on each of these 3 research questions that you have provided. Okay. So finally, communicating and framing. The interaction, of course, it will be good if we do have a more practical and engaging anecdotal evidence. For example, the 2022 tech sell-off or regulatory debates following the collapse of the certain AI-heavy funds. If you can relate those to and relate to your topic, that will be great. Okay, so start the paper with the concrete examples or case study that illustrates the core risk mechanisms to better motivate that paper. So there are a few other minor comments. I think that I will leave it here. I will finish early and leave the room for others to raise questions. Overall, I like the paper. This has got huge potential as we are building. I think that if you consider that some other technical aspects to strengthen and give confidence on your paper, that will be great. Otherwise, thank you. Thank you.
So thanks a lot, Shams, for the discussion. While Joe is replying to the discussants' comments, you may already think about smart questions, maybe without the support of AI, the human intelligent-based questions. Please, Joe.
I would like to thank Professor Shams, Pathan's comments, and they are all very valuable and inspiring. Actually, I will share all of them with my colleagues and try to see how best we could incorporate them into our manuscript. Here we could discuss some suggestions like probably professors suggest that we may use return-based measures to capture or to estimate the post-indicators behavior of investment funds. I think it is true. It is excellent suggestions. We will try to see whether our results would remain robust. He also suggests that we should try to use more rigorous matching approach. We would do so, but actually we have already considered these possibilities, like genes matching approach. Actually, we did not use this approach due to data limitations, as some data variable used in the matching criteria are not available from our data set. But we will try to see whether our results will remain robust for alternative matching criteria in the future to see whether our results will remain robust. We will also add more details about our Gene AI classifications approach. I think this is very useful and let the audience or reader well informed of our classifications methods, and it's very important. Finally, we should also specify that our results may not reflect the situations for other fund types, let's say hedge fund, quant fund, or ETF. Here I would like to share with you that actually we have conducted the same exercise for ETF, and we find that the results are very consistent with what I have presented. So maybe we could also add these discussions in our study. Yeah, that's all. So thank you very much. Thank you very much. Yeah.
Thank you for the rejoinder. I think, Michael, you have a question?
Thanks a lot. I think this was super interesting. You asked for smart questions. I'm not sure it's smart, but it's not AI generated. So at least it qualifies in that sense. The variables you had on AI usage of the funds, they only had an I subscript and not a T subscript. So I was wondering, is there no time variation in the AI usage of these funds? Because maybe that you could also use to think about this possibility of endogenous AI adoption, right? You could compare what were the correlation characteristics of these funds before they were adopting AI relative to all the others, and afterwards, sort of looking at how that changes over time, if there is time variation in your data.
Actually, this variable is time invariant, and we collected this data from fund prospectuses, and the fund prospectuses are those issues at the time when the funds were launched. And in our sample, actually, many of the AI-driven funds were launched in just recent 5 years. So here we will see that these funds are very new and very emerging. And probably, you are right. Actually, there may be some endogeneity issues. Probably we should try to see how best we could address this concern. Yeah.
Thanks. Maybe I pressured you too hard with, so any question is welcome. Please, Guzman.
Thanks a lot. We're already talked about the economics yesterday over lunch, so I'm going to have an AI-related question, not generated. I like the way you asked ChatGPT to give you an extract of what it used in order to say where there was or wasn't an AI-related fund. Now, the thing is that ChatGPT sometimes hallucinates, right? And so you do have a sample that you manually check, but I'm wondering whether you also mechanically checked whether those extracts were actually in the documents. And that's something that you don't need to do by hand, right? You can just write a Python script and do that and get out with 100% precision. So did you do that?
Yeah, I think it's a very excellent question. And actually, I did not explicitly mention what we have done behind the scenes during my presentations in the times of interest, as well as we did not explicitly mention in the manuscript circulated to Professor Sham's Pathan. But here, I could also share our experience in our model selection. Actually, to avoid hallucinations errors, actually, we need to take some measures. And in my humble views, I think there are two possible reasons for hallucinations. First, probably we choose an incapable model to handle the task. I mean, the capacities of the model is not matched with the complexity of the task. There are lots of academic literatures recommend us to use more advanced models to handle the task to make sure that we could avoid any possible hallucinations. So behind the scene, at the beginnings of our study, actually we took a very cautious approach in selecting our Gen AI model. In the evaluations, I would say we evaluated numerous Gen AI models available at the time of our study. In our evaluations, we exclusively focus on their language skills and comprehension abilities, since both abilities are very essential for us to handle the identification task. The selected model needed to read a vast amount of complicated and lengthy prospectuses, where a total of 20 each language were in use. So we needed to find out the best model to handle the task. In terms of language skills, actually we drew samples of prospectuses per language in our analysis, and we asked different models to give us a summaries of the document. Through this approach, we evaluated their understandings of different language. And in terms of comprehension skills, we also arranged a lot of prospectuses. All of these prospectuses contain at least one AI keywords, but only some of them truly indicated the AI usage of the funds. So we asked different models to try to analyze this document and identify the AI usage. Through these two evaluations, we find that ChatGPT 4.0 latest was the best performer at the time of our study. So we used it. I could also share some experience that at the beginning, we have used less advanced model, let's say ChatGPT 3.5, possibly due to cost considerations. But we turns out find that it very often committed hallucinations. And we find that if we use a more advanced model like ChatGPT 4.0 latest, it could significantly minimize the errors. We also take another step to make sure the accuracies of the identifications. Actually, hallucination error may arise from ambiguous or unclear command given to the Gen AI model. So that's why we need to make sure that our command is clear enough and free from ambiguity. Just take an example, like when we ask ChatGPT to identify various use cases of AI by investment funds, we explicitly defined what these investment strategies are. Say, in terms of asset value predictions, we explicitly define that these strategies refers to using machine learning technique to predict asset values, often to identify the undervalued assets for investment. So this clear enough commands make sure that our Gen AI model would not misunderstood our command and avoid any unnecessary hallucinations. For sure, we also conducted 2 rounds of validations. as I mentioned earlier, we follow academic literature where they use Gen AI model as well to power their textual analysis. We drew a samples of outputs from ChatGPT and manually reframe them and make sure that ChatGPT 4.0 latest could almost perfectly identify the AI usage. We even went beyond the academic literature by extending the scope of validations to every output of ChatGPT by using Code 3.5 Sonnet, so that we make sure that every output from ChatGPT could be well reframed by either by us manually or by Code 3.5 Sonnet. That is how we make sure the accuracies of our work. Yeah, I hope I make myself clear. Yeah, thank you.
Please.
Thank you, Ivan Mikhailov, Capgemini Services for ECB. This is AI-generated question disguised as a human one. I've recently read a report on AI-generated text detection mechanisms, and there is an evidence that it's quite easy to fool such mechanism by asking the original AI to disguise the result as one would be generated by a human. This is commonly known as adversarial attack. By certain manipulation, like adding spelling mistakes, burstness of the text, and so on. My question is, have you considered adding this additional dimension of analyzing intentionally manipulated data to check the robustness of your AI detection mechanism?
Sorry, I may not fully understand your questions. You mean?
Have you added to your data? Have you considered to add into your data set intentionally manipulated data to compare how well your AI detection mechanism can work?
You mean whether I have tried another Gen AI model to see whether?
So if you try, for example, you use prospectus for the, let's say, artificially generated prospectuses.
Yeah. So have I tried any other documents types?
You mean you add fake prospectuses, right? Okay. So if you prevent your model with fake prospectuses that are AI generated, that are not coming from a real bank or investor, how would the thing perform then? Would it detect them as fake ones?
Oh, actually, I think it's fully relied on. Actually, I would say a very short answer is we just fully relied on our manual reframes of the outputs of ChatGPT and try to see whether it is correct or not. And actually, we try to draw about 10% of the outputs from ChatGPT to see whether there exists any errors. And if there is any errors, for sure, we manually correct it for them. So, and as I've mentioned earlier, actually, we also use another Gen AI model to see to estimate the overall error rates of ChatGPT, and actually just 1%. I think this is a very low level and may not significantly affect our identifications or the result. I hope that is clear enough. Thanks.
Thank you. I think we need to conclude with this session. If you can have your session for the coffee break, question for the coffee break, that would be nice. So. We have something in common, I think, for the two sessions. So some of it was AI predicting a bit the future, at least regarding future returns in your model. So now it's again about predicting the future in terms of macro. So Sophia, the floor is yours, please.
Hi, everyone. First of all, huge thank you to the organizers. I think this is a fantastic venue to present this paper at, and I've been learning so much over the past 2 days, so thank you again. This is a new working paper. It's written with a wonderful group of co-authors, so feedback is greatly appreciated. In this paper, we're simulating the survey of professional forecasters, and we're doing that with a set of large language models. So before I jump into details of the simulation and our results, let me just spend a slide convincing you that this is an appropriate method for doing such an exercise. So over the past several years, we have seen this explosion of interest to large language models. And what's good about it is that it produced this large and growing body of literature studying these models and trying to understand what they can and cannot do. So what these models can do is they can produce responses that are consistent with documented patterns of human behavior. And this result has been replicated across multiple fields, across multiple contexts. And obviously, the papers listed on the slide is just a very tiny slice of that literature. So what this means is that LLMs are, in essence, good enough approximations of humans. And we use this property to address the following issue. We all know that survey data, good survey data, is very hard to find, right? And survey-based forecasts are especially so, right? So survey-based forecasts, such as the survey of professional forecasters, is used widely by numerous people, right? So it's used by the Fed and the US Treasury to make decisions. The ECB uses a European counterpart of SPF. Academics use SPF, practitioners use SPF, so it's very valuable data. At the same time, collection of this data is costly from multiple perspectives and is therefore sparse or infrequent. You also can't really introduce new questions into such surveys. I mean, of course you can, but for them to become valuable, to produce valuable insights, it takes a long time. So if LLMs can serve as good enough proxies for simulating the behavior of economic agents, perhaps we can use these tools to augment survey data collection. And this is exactly what we're doing in this paper. We are essentially building synthetic forecasters using data derived from the survey of professional forecasters based on actual real personas. And once we construct these personas, we have them simulate this survey as closely as possible to the actual real thing. And I will go over all of the steps and explain exactly how we do this. But first, let me spend a few minutes explaining the framework or how we think about human and AI forecasting. So let's say that forecasting process is a function of two inputs. A set of observable predictors, X, and a set of unobservable predictors, Z, plus some error. So observable predictors is anything that could contribute to predicting Y, right? And also anything that could be easily or fairly easily quantified and included in the model. Now, unobservable predictors, Z, is anything that provides additional information that could help predict Y, but is either very hard or virtually impossible to quantify. So things such as intuition, vibes, private insights, domain knowledge, internalized rules that are very hard to express, things like that. So humans can access both X and Z, right? We are, we can sort of read signals that are not necessarily quantifiable, not in the hard data. We have intuition and so on, and we can also process X. But due to our physical limits, we process both types of data imperfectly, right? If you give me 2 variables to consider, I can handle this task. But if you give me 100 variables to consider, my head will explode. Same with that. Some people ignore their intuition. Some people put too much or too little weight on it. So there is this human bias when it comes to processing this information. Now, traditional algorithms cannot access that, but they are really, really good at processing X, right? They're really good at this direct mapping of X to Y. That's what they're built for, right? Think typical linear regression or traditional machine learning models. LLMs are similar to traditional algorithms in that they cannot access that. They can only access X, right? They cannot access that. But their expectations are formed differently, right? They're not just looking at these multiple X, Y pairs. They are relying on this massive text-based probability distribution to make their prediction. So there is already some hint of that in that text data, right? That was human-generated. But even if not, in our framework, we're saying that if we want LLMs to act, to predict as humans, we essentially need to minimize the distance between human bias and LLM bias. So how can we do this? Well, we can provide LLM with certain additional inputs. For example, we can give the LLM forecaster characteristics. So that would take care of the systematic patterns in the human bias. We're all different, we all process information slightly differently, so including that information takes care of that. We could also give the LLM past forecasts made by humans. Since humans are considering both X and Z in their forecasting process, providing past forecasts to an LLM gives LLM access and allows to proxy for that unobservable Z, at least partially. It's not the perfect mechanism, but this is what we can do to try and get an LLM closer to human. So this is how we think about our setup. Spoiler alert, we find that LLM actually outperforms human forecasters, at least in some scenarios. And we think that this is because we both give the model access to that, and LLMs being powerful neural net deep learning models can process X more efficiently. So that combination really is what helps LLMs make these predictions well. Very briefly on the survey of professional forecasters, this is one of the oldest macro surveys in the United States. It's been launched in 1968 and has been at the hands of Philadelphia Fed since 1990. It's a very large survey. Essentially, it has forecasters provide their predictions for 23 variables over 9 horizons. So a lot of data. And survey responses are released at the individual level, but without forecaster identifiers. So we see individual forecasts, but we don't know who made which forecast. There is a link here, but I can probably not access it in any event. So Philadelphia Fed, together with the forecasts, publishes acknowledgements for people who participated in a given panel. It provides names and affiliations. So we use that data to build our synthetic forecasters. I will go into a little bit more detail in a bit. So our goal is to replicate the SPF as closely as possible. So we replicate all of the 23 variables in the sample over 5 horizons. We had to limit ourselves because it was a huge amount of data to generate. And our sample spans 1999 to 2023, plus we use the data from 2024 as an out-of-sample exercise. All right, so how do we set up our simulation? As I've said, we use the names and affiliations from the SPA acknowledgement section, as well as the year and quarter, to find publicly available information on the SPF participants. So that took us a bit in terms of data collection. But we essentially double-check that these people are in fact SPF participants, and we collect all kinds of characteristics about them. Their education, alma mater, when they graduated, where do they work now, what is their title, things like country of birth, whether they're active on social media, professionally, and so on. So by doing this exercise, we're actually able to see who participates in the SPF survey in the United States. So I have a couple of quick summary statistics here. So the panel is mostly male. The graduation year is relatively evenly distributed, so you have people who are kind of younger graduates, and you have people who with more experience. It's mostly PhD economists, although you do have some MBAs and masters, and people who come from fields such as public administration or business and management, but mostly PhD economists. This panel is pretty diverse with respect to affiliation. You have a lot of people from consulting, you have people from investment banking, commercial banking, manufacturing, asset management, all relevant industries are pretty well represented here. And you can also see that most participants on the SPF panel either give interviews professionally or post on Twitter or X, again, professionally about their forecasts and so on, not just, casual kind of posting. So we use that information to build our panel of synthetic forecasters. We essentially give them the information that would have been available to their human counterparts when doing these predictions. So we give them things like real-time data, real-time in the Orphanides sense of the word. We give them past SPF forecasts, again, something that their human counterparts would have had access to. And then we instruct the model. In our case, this is a set of models, so we've tried all of the OpenAI ones, and we've tried Llama and DeepSeek, and the results are relatively robust to the choice of the model. And we have the model generate these predictions for 23 variables over 5 horizons at the synthetic forecaster level. So this is the prompt. This is essentially the heart, the engine of the simulation. I know it's a lot. I'm going to break it down into pieces here. So we start by defining a persona for our simulation, right? So we're essentially telling the model, you are a participant on the panel of survey of professional forecasters. And then in red letters, those are essentially the inputs for characteristics that we gather. So we tell them your name is as follows, you graduated from this school with this education around this year, and so on. If the information is missing, we simply do not include the sentence with the missing piece. Next, what we do is we attempt a so-called temporal restriction. Since the model is trained on the whole sample, we want to make sure that it's not using information that is kind of forward-looking. So we are saying, we are in this quarter. You're about to fill the forecast for this quarter. Using only the information available to you as of this quarter, please provide your forecasts. Then we also give them the real-time data for relevant variables, as well as the past median forecasts. And again, another temporal restriction, basically saying do not incorporate any data that was not available to you beyond this date. Consider all relevant information, but make sure to only consider it up to a certain date. And we give some additional instructions about the survey, essentially asking the model to return the predictions in a certain format, and so on. So this is it. This is the setup. The simulation, we then run the simulation at the forecaster quarter level. And there are about 40-ish participants each quarter. Okay. All right, let's look at the results. So as I've mentioned, this is a huge simulation, a lot of results. I'm only going to show you the results for the following 4 variables, but I promise you there is no cherry picking. The full set of results is in the paper, and we also plan to make the data publicly available. So what do we find? We essentially come to the following 3 main takeaways. First, we find that AI and human forecasts are qualitatively similar. Although there are some quantitative differences, but they're not almost never economically significant. Next, we find that AI often achieves higher forecast accuracy. But we also see that this is contingent on the model getting human inputs. So if we take away the human inputs from the model setup, this accuracy deteriorates rapidly. Okay, so let's look at the first set of results. Here we have the median forecasts for CPI inflation 1 quarter ahead and 4 quarters ahead. So the light gray represents human forecasts for CPI inflation. Dark gray represents forecasts for AI. So this is probably the most dramatic example. You can see that even though the two forecasts kind of track and follow each other, there are some dramatic deviations of AI from human forecast. This happens during crisis periods, and AI forecasters seems to react more strongly to the changes in economic conditions. This pattern holds for other variables, although less dramatic deviations. For other macro variables, this is T-bill rate, unemployment rate, and real GDP, and we have all of the results in the paper as well. So let's also look at the densities of forecast errors. Again, since a lot of data, a lot of ways to represent it, here we're selecting 4 different quarters: the first quarter in our sample, the last quarter in our sample, as well as the Great Financial Crisis and the COVID period. And you see the densities in light gray. Those are human forecast densities, forecast error densities, and the ones in dark gray are the AI forecast error densities. So in principle, you can see that they're aligned, but AI predictions seem to be more narrow, so there is less disagreement and less variance when it comes to forecasting. Although during periods of economic crisis, this advantage disappears essentially. And again, this result holds for other variables in the sample. Okay, now let's look at the accuracy. So what we're finding essentially is that AI forecasts often outperform human forecasts, especially at longer horizons. It doesn't hold for all of the variables in our sample, but it holds for variables such as GDP and unemployment rate, which we think is quite promising from the policy perspective. But again, this is contingent on us giving the models human input, right? As I've said, we think that this edge in performance stems from the fact that LLMs are able to extract this latent information Z from the human forecasts while also being able to process X, the hard observable data, more effectively. So here we have the proportion of quarters where AI is more accurate than human forecasters. And looking at that, you can say that AI is more accurate than humans for most variables across most horizons, essentially. Okay. So let's talk about the fact that this result hinges on us giving the model human inputs. So we wanted to try and understand which parts of the human input data is the most important in the simulation. So to get to that, we essentially replicated our simulation but we systematically took away pieces of information from the prompt. So the first column here called generic, this is essentially the same simulation setup, but the only difference is that we're taking away the personal characteristics of forecasters. So we're essentially doing a simulation with this generic persona. And the values in the table are the mean average errors of this new simulation divided by mean average errors of the original baseline setup. Right? So everything that's bigger than 1 means that there is a deterioration in the forecast accuracy. Right, so clearly there is some edge in providing the model with human characteristics here. Next, looking at the second column here, we take away the personal characteristics as well as access to real-time data, right? And we can see, looking at the values, that accuracy deteriorates further. And finally, in the third column, we take away both personal characteristics, real-time data, and past SPF forecasts, right? So clearly, the information in the past forecasts carries a lot of signal in it, right? So there's a considerable deterioration in the accuracy here. Okay. Another important point, and something that always comes up when using large language models for prediction tasks, and it's a fair critique, right, is that LLMs are sometimes subject to temporal leakage, right? They're trained over the whole sample of the data, so they, in principle, know what happened in the future. So the worry here is that LLMs might recall future data from its training set. So we take some mitigation, we have some mitigation techniques here to avoid this. For example, the piece that I showed you was in the prompt, right, where we verbally tell the model to only consider the data up to a certain date. We also give the model real-time data, right, no future information, and we run an out-of-sample test on the data from 2024. Which was outside the model's training window. So several mitigation techniques that kind of give us some peace of mind when it comes to using LLMs for forecasting. But another thing that we do is called the recall test, right? If the assumption is that the model simply recalls relevant values from its training set, it should be able to give me the value of GDP in the second quarter of 2005. If I ask it. So this is precisely what we do. We run the simulation, but instead of asking the model to forecast, we ask the model to recall specific values, right, for specific variables in our sample. So what we find is that when we do that, the errors are about 16 times larger than when we run our baseline forecasting framework. So it's clearly not working as if it's fishing into this huge bag of data and pulling relevant values. Something more complex is going on behind the scenes. Right. So what is this paper about? I think on a very high level, this paper is about the fact that humans have a certain edge in forecasting, right? We're able to process signals that are not necessarily quantifiable, let's say, and machines have an edge in forecasting. So the goal is not to substitute humans with machines or for humans to ignore machines, but to come up with a framework of augmentation, right? A hybrid approach where we can blend the advantages coming both from humans and AI. On a more practical level, we believe that this framework is promising, a promising tool for policy or research, and can be thought of as this virtual forecasting lab of sorts, and we plan to set up a dashboard or a tool where you can access these types of forecasts, or maybe even run your own. With respect to tools, we have used several things, but one of the packages that I would recommend to people who are interested in trying these types of simulations is called expected parrot. So this This is a set of tools that allows you to run experiments with multiple agents and models at once. And a little early, but I will stop here. Thank you very much.
Thanks a lot, Sophia, and Michael will discuss the paper.
Thank you. Thanks a lot for having me and for giving me this paper to read and to discuss. And this was really a lot of fun, I have to say. Obviously, given that I'm here at the ECB, everything I'm going to say are my own personal views, not those of this institution here. I'm actually going to skip my summary. Sophia did a great job in presenting. I think it was very clear what she does, so I didn't even prepare much for that slide. Let me go straight to my comments. I think this was really an interesting paper to read. To me, this was very novel analysis, and execution is just really, really well done. I have to say, I found it thought-provoking right from the beginning until now. I mean, there's one thing I don't want to really put to the discussion. Probably that's something more for a coffee break discussion. But you know, the line of reasoning in some way in that paper is, well, running surveys is costly. So can we actually find a way of generating human-like input without incurring the cost of surveys? If you take this line of thinking further, you know, you can should probably start thinking about sort of the limits of how we want to use AI, because running parliamentary elections is very costly, right? And you know, right, I stop here. So it really sort of provoked my thoughts, this paper. You know, what are the limits of what we can do with, or should do with this? But the comments I would want to put here for discussion are mainly twofold. You know, the paper is very clear in its exposition what it does. I'm still not fully clear about the ultimate objective of the paper, and I want to push you a little bit to be clearer about what that actually is. And then secondly, I think one of the issues in the paper is that the SPF has anonymous individual forecasts. So what they do in the paper is they generate this synthetic forecasts, but they can never sort of see whether the LLM actually matches the individual forecast, right? We only can see how the distributions look like, or the aggregate looks like. And you know, maybe we can think about ways to cross-check whether there is a match going forward. This paper, again, to me was very new. I think, you know, we have a lot of papers that use LLMs for forecasting, and we have papers that use LLMs for conducting surveys. Again, just a very small snapshot of the literature out there. We know that we can use LLMs to forecast macro variables. We already know that they can outperform the SPF, so there's one paper on this. Colleagues here in-house have used LLMs to include textual data to do inflation forecasting. So they're using text from the ECB's press releases, and they show that using LLMs helps to improve inflation forecasts. And there's also papers which already think about, you know, along the same lines, running surveys is costly, can we use LLMs? But the angle of the paper that is listed here is more like recruiting interviewers is costly, right? So can we replace the interviewer, not the respondent, you know, and they actually find that LLMs do very well in probing the interviewee, in moderating the survey, in giving a summary back and you know, asking follow-up questions, and then sort of deciding when to move to the next question. Now this paper here is then really thinking about, can we have these individual forecasts, and to what extent is this helpful in forecasting? Now, again, I'm not yet fully clear what the ultimate objective of this is here. And so I started thinking about, why is it that actually central banks not only use those surveys, we actually conduct them, right? So both the SPF in the US and the SPF here in the euro area is actually conducted by central banks. So we put in resources to do this. Why do we do this? Well, I think in the first place, because we want to get good aggregate forecasts. If you look at this press release of the ECB for the latest release of the euro area SPF, it's all about aggregate forecasts. So probably this was the starting point, right? And again, why would we then run surveys to do this? Well, because surveys with lots of individual respondents can aggregate information differently. And I'm using the same notation as Sophia had in their paper, but I'm changing this a little bit. in the sense that I'm putting more I subscripts here. So I would think that we all have access to public information, so I call this XT here. But then Sophia and I, we see also private signals, and so by running surveys, we get all of these private signals into the survey, and we can aggregate this up to hopefully get better aggregate forecasts. But then also our aggregation is different, right? So the F here also has an I subscript in the sense that we might be using different forecasting models or the same model, but we have different parameters in the model. And then lastly, there's this term which they call the bias in the forecast, which again, we all might have different biases here. Now, I do think that all of these three parts can be a function of personal characteristics, not only the bias, right? And I think the first part is very important for us. We want to aggregate different information, and we want to have people who actually see different private signals and have different forecasting models to get sort of a better aggregate forecast. So I think we want to differentiate these two things here in the analysis. The second reason why central banks conduct surveys, and I presume this, we started realizing this a little bit later, is it's actually very helpful to also look at the distributions, right? It helps us understand disagreement. There's a big literature to what extent disagreement is a good proxy for uncertainty or not, but we also ask for uncertainty directly in the SPF, in both variants actually. And so, in our SPF reports, we also plot the distributions, of course, that we're gonna get from the individual forecasters. So that's helpful. And then probably it's also good for us to understand really what are people's actual expectations, because we know people act on their behavior. And there's now a lot of models that include heterogeneity, like Hank models, where we know, people might have different marginal propensities to consume. And so it's important to understand to what extent actual expectations differ, because that might have macroeconomic implications. Now, against this background, what is the objective of the paper? I can see various reasons why we would want to do this. So again, is it that we want to just have an improved aggregate forecast by going via personas? Then I think the paper needs to have a little bit more discussion why that actually is helpful. Why can I not just go to the LLM and sort of say, try to come up with a median forecast? Why do I need to go via the individual personas? Where is actually the improvement coming from? The second possible objective could be, again, let's think about this cost-saving motive. Can we just generate more survey responses and cheaply so? But then I think what the paper should do is, it should also show, like, if we increase the number of survey responses that we generate, can we actually improve the aggregate forecast? Right now, you just stick to the actual population, or you're trying to mimic the actual population of the SPF. You're not trying to expand that. Third thing could be, do we want to get a good estimate of the human bias here? And again, let me go back to this equation, right? Can we sort of get rid of the delta IT and just sort of see to what extent is it actually useful to aggregate individual forecasts by eliminating the human bias? And again, some more discussion on that, if this is the objective in the paper, would be useful. Or is it that we actually want to have this data and we want to send them to our policymakers and say, here's actually a good, or maybe a better assessment of the disagreement that is currently out there in the economy? Well, if this is the objective, then probably we should not be so happy that the LLM actually improves on the individual forecasts, right? These distributions actually look different, and they are smaller. And again, if we want to understand the proper disagreement that is out there because people behave according to that disagreement, then not so sure this is actually a helpful avenue. Or another objective could be that we want to go to our colleagues in-house and advise them, how can we actually change the forecasted population to get better aggregates? Like, for example, would it be helpful to increase the share of females in the sample, right? Do we get sort of better output here? So lots of different things one could do with this, and I think the paper, to me at least, wasn't fully clear where you want to go, and depending on the objective, I think some more follow-up would be actually helpful. Second comment on benchmarking these synthetic forecasts. Again, the SPF is anonymous, so you can never know whether the LLM actually sort of really mimics the individual or just happens to sort of roughly sort of mimic the distribution. I think it would be good to actually get at this. And so I was thinking, is there other ways of doing this? Can we, for example, use other surveys beyond the SPF? So the blue chip or consensus economics provides the company name. So we don't have the individual within the company, but at least we know which company provided the forecast. And that can be helpful information to understand, again, what is the background of this company. Similarly, the Livingston survey provides 11 different categories. So you don't know the company name, but you know, is this from an academic institution or a commercial bank or a non-financial business? Again, that can be very helpful. And there you can actually match the forecasts to possibly synthetic forecasts. Or you could go to the Bloomberg survey. There is a survey that is run by Bloomberg where people sort of nowcast. They basically give a forecast of next week's macroeconomic announcements and next week's monetary policy decisions. That's not your forecasting horizon that you have in mind. It's a nowcast. But there you actually know the individual. You know everything about that person because the forecast is done in the name of the individual. And we looked at this a couple of years, well, many years ago by now, to sort of see who is actually a good forecaster of FOMC decisions. And we found that forecasters are better if they are located in financial centers. Individual characteristics matter, right? So it matters whether you're, for example, in an investment bank, then you're a better forecaster. Economists do better forecasts than the executives, for example. Or people who have a background who have worked at the board of governors actually are better forecasters of FOMC decisions. And maybe of interest to the group here in the audience, among the education types, the PhDs actually are the worst forecasters in that sample. But this allows you to actually now match these forecasts to individual characteristics. So maybe going down that route could be helpful. Then one more thought. Why does ChatGPT actually give you different forecasts? So I was running something very simple. I asked, I also sort of generated personas. I asked ChatGPT to give me a forecast for 2027 CPI inflation in the US. So one persona is a Yale PhD in economics, an economist at an investment fund based in Houston, Texas. And that gives me 2.2%. The other persona is a University of Maryland master in finance who's working as a CEO at a commercial bank based in New York City, and I get 2.3%. And then I asked ChatGPT, why did you give me different forecasts? Turns out that ChatGPT completely disregarded the education, completely disregarded the location. It only focused on one guy is an economist at an investment fund, the other guy is a CEO at a commercial bank. And so I think it would be good to understand really where these forecasts are coming from. And related to this, then also my question to you, how did you decide on the characteristics for your personas? So you were including some of these characteristics, but not others that you have. Like, for example, gender is not included there, right? And we know that in consumer surveys, this actually matters, right? We know that females have higher inflation expectations. So why did you actually include some of the characteristics that you have and others not? And then again, the question would be, which of these are actually of relevance to ChatGPT and why? Now, if you want to stick with the SPF, I think you can still try to understand a little bit better to what extent the synthetic forecasts match the individual forecast by also looking at across variables. Again, there's a large literature you can relate to sort of see, are these just random forecasts or is there some economic intuition behind the simultaneous forecasts of different variables like output and inflation, for example, and interest rates. And then last, as I mentioned before, both the US and the Euro area SPF not only ask for point forecasts, they also ask for distribution for some of these variables. Have you looked for that as well? I think that would be interesting to sort of see how that works out. So, summary, I think this was really interesting, thought-provoking. I would suggest to clarify the objective of the paper and then to develop that part accordingly and to try to benchmark the synthetic forecasts. And I was very happy to see that the conclusion of the paper was that the LLM should augment rather than substitute human forecasters. So, which made my sort of big worry about this a little bit less serious. So, thanks a lot.
So maybe you want to respond first, Sophia.
Yeah, absolutely, Michael. First of all, thank you for such a useful discussion. I do agree with you that we need to work on kind of sharpening the objective, at least in the paper. I think initially it was a proof of concept type of exercise. We really wanted to see whether LLMs are able to do this task. So we didn't have a prior necessarily. We're thinking maybe LLMs could match human forecasters perfectly, right? If given enough relevant information. Or maybe they won't be matching the human forecasters, but they would perform really well at the task. And what we observed is a mix of things. So we believe that this could be used, again, it's a proof of concept, but this framework could be used in other contexts. If LLMs are properly anchored to human data in an appropriate way, we could augment other data series frequently and cheaply. But that's absolutely a fair point. So really a lot of food for thought. Thank you. In terms of the last couple of points, so gender, we are giving them names. So our assumption was that gender is inferred based on the name. So we believe that these models are sophisticated enough to infer gender, but we could kind of do some tests to see if it works. That could be interesting. I loved your difference in forecasts exercise, right? Trying to understand which characteristics are driving the differences. So we did something in that spirit. I don't think we're including it in the recent version of the paper, but maybe we should. So we did also find that affiliation made a huge difference there. Yeah, otherwise, thank you so much. Great suggestions. Really appreciate it. Thank you.
Actually, Michael summarized these AI can augment the SPF. So I asked ChatGPT before, just bluntly, will AI eventually make economic service like the SPF redundant? And guess what the answer is? Yes, I will win in 2 years. No, the answer was no. Exactly as you wrote the paper without confronting with your paper. It said like, has the potential to significantly enhance economic forecasting. It is unlikely to completely make traditional service like SPF redundant, and instead AI can complement each other, and they can in several ways. So very wise statement already. So we have the first question, please. Microphone is coming from the left.
Thank you. Jonathan Haskell, Imperial College. Thank you, Sophia, for an exceptionally clear and interesting presentation, and to Michael for the discussion as well. I should declare an interest. I've just finished working on the Bank of England's Monetary Policy Committee, so the idea that a machine could have done a better job than the 6 years that I did on the committee terrifies me. So let me say, let me try and talk for humans in support and raise 4 issues, if I may. The first question is, some of your graphs showed very dramatic spikes up and down. So one of the big things about monetary policy, of course, is the idea to try to detect turning points. So would I be right in thinking that the model is bad at turning points or good at turning points? Could you just amplify that a little bit?
Yeah. Sorry.
So if I could just say, sorry. The second thing is, at least at the Bank of England, one of the things that we had to spend a lot of time doing was communicating what we were doing to non-economists. And I have to say, if we had gone in front of Parliament and said, well, we just gave it to a large language model and that told us what to do, even if it had the imprimatur of Stanford economists and all that kind of thing, I think we would have looked silly. So again, some sense of how that fits in with the communication. The third thing is, of course, the outcomes are in some sense deeply endogenous to what it is that policymakers announce. So during the Liz Truss financial crisis, where we had a big panic in the long bond market, if we'd run a forecast of that enormous panic, we would have forecasted that the British banking system would collapse and the entire British economy would fall to pieces. So we deliberately did not announce that forecast, although that was the correct forecast. Instead, we said we're going to try to rescue the market and all of that kind of thing. So that was an example where it was optimal, it seems to me, not to say what the forecast is. Final thing, if I may, I'm sorry for this long question, is in some sense, there's a much deeper question, I think, about what we mean by human biases, the big delta, I think, Michael, in your discussion. I just don't think there's a sort of true model out there somehow or other which humans are just incapable of processing because we have limited processing power. I just think there's radical or Knightian uncertainty. There are things which we just simply cannot predict. If you'd asked us 30 years ago to predict what an Apple iPad is, nobody would have any idea what it is. So I just wonder if you were talking about human artificial intelligence. Is there work done in Stanford or elsewhere in thinking about how we think about what a bias might be in a world where there just isn't a true model? It's not that we're trying somehow or other to get to some true model. It's just that there's this irresolvable uncertainty. Apologies for the long question, but again, enjoyed the presentation very much. Thanks.
A concise answer to this quartet of questions because we have some of interest. Please.
Thank you so much. Really great questions. So to start from the beginning, the turning points, there are indeed large spikes, at least for some variables. So we think that this dramatic overreaction comes from the fact that the model cannot access Z. So when there's a lot of change on the ground, you do need information beyond just the hard data. So human forecasters have access to that, and the model doesn't. Again, perhaps this is possible to kind of address with more data, but that's a good point, yes. The use of LLMs, I absolutely see your point, and I think for central banks especially currently, this is a reputational risk, right? The message to the public needs to be very carefully drafted when it comes to use of AI, right? At the same time, things are changing. So perhaps in 5 years' time, this would be a standard method, right? And people would be comfortable with that. So time will tell in that regard. So selective announcements of forecasts, right, when things are really bad. That's a fair point, but at the same time, you do need to know what people are thinking and expecting. Not necessarily act on it, but that's another job of a central bank to kind of assess people's expectations about the future. So having this type of data, even if you don't release it, is helpful for decision making, I would assume. And the last question, that's, again, so some people yesterday said that they forgot their crystal ball at home. Same. It is an important question, though, so something to think about. Thank you.
Thank you. I think we have a mic already up here.
Hi, Stephen Batiste from Inferred Mind in Menlo Park, just down the road from Stanford. You're predicting future events based on past events. And then you're asking the LLM not to cheat in a nice way. And then you're also using the LLM to see whether it's actually cheating or not. But my biggest concern is that the LLM, you don't know, it's a black box. You don't know what's been trained on data-wise. So it actually may be trained on data that is assisting it in ways that you don't know.
That's true, to some extent. So we are doing an out-of-sample validation exercise with the data that was definitely not included in the training sample, and the model, our setup, performs fairly well. But yeah, I mean, it is a concern. There are some ways to overcome it. There are some large language models with kind of consistent training cutoffs. I think Asaf Manella has a recent working paper on that. So perhaps we will try using that.
Peter McAdam here in the front row.
Thanks. Great paper, of course. I think behind this paper is the idea that forecasts are atomistic, that everyone is in their own little cubicle and they're forecasting. But forecast cluster, for example, if unemployment right now is 3% and my model tells me it's going to jump up to 7%, I would never put that down because I don't want to look an idiot. So I wonder whether that is somehow in this machinery, whether there is the fact that people don't, it's a beauty contest. You don't kind of forecast, you forecast with a view to what other people are forecasting.
Peter, it's a great point. I mean, I think what gives us a bit of peace of mind here is that SPF is anonymous. So in principle, that should be able to protect you from going with your forecast, going with what your models say, and not worrying too much about, the huge gap between you and what other people are saying. Yeah, I mean, something to think about.
You might worry you won't get re-invited by the central bank next time around, no?
Maybe, perhaps.
Yeah. Katarzyna Budnik had a question.
So thanks for introducing me, Wolfgang, ECB. So here are two questions. One is friction stolen by Peter, but let me give you a narrative. So my first job was at a commercial bank with investment profile. I didn't have a PhD, that's why I was allowed to provide this type of forecast, and I give you a narrative how it looks like. So there's no one survey. There's a survey each week or even bi-weekly, depending on the announcement time for different data points. And the way it works, let's say we predict inflation, it's like we get a survey 3 months ahead, 2 months ahead, 1 month ahead from different providers of the aggregated forecasts. And of course, we do look at the outcome. And we do cluster, and I tell you why we cluster, because especially in this investment profile companies, if we deviate too much upside or too much downside, it means taking a stance on our trading position, and it can hurt. Back that time, it still could hurt you personally by your bonus at the end of the year. So what I want to say here is that one of the very important information, and this to give a bit of a flash to what Peter said and how it can be operationalized in this model, is to feed the machinery, to feed the artificial forecaster with the outcomes of the surveys about the very same data points, different surveys, be it Bloomberg survey, whatever surveys are there released, as one of the data points the forecasters take into account. Because I think at least partially that might explain the spikes in the forecast by the machine versus lack of spikes in the forecast by professional forecasters, because people do cluster. I mean, there is an element, I don't want to be an idiot, but there is also the element of I know the data, I know what the other people say, and essentially I don't want to deviate too much. So that would be one thing. And the other thing I think is Michael very well summarized, that you touch many points. And I find your paper very nice storytelling of what can explain diversity of forecasts and what can explain this persistent distribution of different forecasts across individuals. So I was thinking is what you have different forecasters. You have professional forecasters. You have this commercial forecasters. And Michael very well recalled his own paper from time ago when he distinguished how they err. Would it be possible to tease out a bit more about how those different professions err? Or how those what are the ingredients which are responsible for biases of different professions? Because from my own narrative, from my anecdotal, let's say, experiences, I do know that for investors, this means a statement. I think for academics, what really matters is less the statement, it's more about, I don't know, integrity over time. So there are different drivers, and probably there are different biases, and I would find it very interesting. I think you have methodology, you have good narrative to push it in this direction. Thank you.
No, this is great. Thank you so much. I think your experience kind of provides more support for the fact that it clearly matters where the forecaster is employed, right? So kind of support to that. Yes, we can definitely tease that out, right? We can leave out a certain subsample of our synthetic forecasters, let's say, that are in investment banking, and see how that impacts the results. So that's a great point. We should elaborate on that more. And yeah, I mean, it's definitely possible to include predictions from other forecasts. That could also make a difference. So thank you. Yeah.
One last question, please.
Greece. I'm working in forecasting as well, so I'm really scared a bit by your results. I'd like to come back and actually echo some of the questions. I was surprised to see that you needed to build these personas. I mean, I would think that the professional forecasters would be a very homogeneous group. I mean, I would definitely understand this if it was a kind of a consumer survey. But with professional forecasters, I'm surprised that you find this difference. And the other one is I got a result that suggested that the LLM was not so good in the short-run forecasts. I remember there has been some point back in Greece that we said that it's impossible, it's very hard to forecast what will happen this year, but we can easily say what will happen in 20 years' time. So it may be possible that that the prompt that you're using for the short run, it needs a bit more information, and that will yield better results compared to the long run, which is impacted by less factors, really, compared to the short run. Thank you.
Thank you so much. Yeah, so in terms of which characteristics matter for the forecast, again, we didn't have any priors here, so this is just the data speaking. But in terms of short and long-term forecasts, so I think humans do probably have advantage over AI in the short term, right? Simply because, again, it's sort of like being on the ground and seeing what's going on, right? And not necessarily looking at structured data or economic indicators, but I don't know, going online and seeing what people talk about or kind of experiencing life, right? So that definitely adds information to the forecast. And for the long term, the machine seems to have more edge there, right? Because perhaps quantitative information matters more in the long run. Yeah, so those are my two cents here. But happy to talk further.
Perfect timing also. This brings us to the end of this super interesting session. We have a coffee break now, and we reconvene at 4:05, so 16:05. There's ample opportunity to speak again with our great presenters, Joe and Sophia, and also, of course, with Discussant, Michael and Shams. Please join me in thanking again the